Hello guys and welcome back again to the Babylonians Crypto channel. Today we're going to talk about Synthetix protocol and we'll talk about what it is, how it works, as well as how to stake, the future potential catalyst of it, as well as the risk of it. So to start off, Synthetix is a blue chip OG DeFi protocol, but they have not been gaining a lot of traction for the past few years, and later we'll talk about why. But recently they are showing a huge sudden surge of revenue and trading volume, as you can see over here in June, and you can see that the market cap also has been starting to increase to reflect the change in fundamentals. And if you look at the crypto fees, Synthetix also has joined the top 10 protocols in terms of the average fees that they have earned. And this is quite a trending narrative right now because everybody now is talking about real use, organic revenue generation, and this is how much they are earning for the past 7 days. And if you compare Synthetix since January against like the popular GMX, you can see that they have been pretty flat for the whole of the beginning of the year, but now it has almost caught up with GMX already. So this is based on the 7-day average, and also Synthetix is giving out 100% of its fees back to stakers, as compared to GMX where they only give like 30% or 70% depending on whether you hold GMX or GLP. So again, if we look at the Synthetix stats, this is on mainnet. Also, you can see that trading volume, suddenly something is happening over here. Here is the breakdown of it. You can see that it comes from 1 inch Quanta curve. So this is on Ethereum and this is on Optimism. Again, suddenly there's a surge of all this volume that's coming because they recently launched their futures on L2. So before we talk about what happened recently, this is just a brief overview to understand how Synthetix protocol works. So at its most basic, it is a derivative protocol that allows you to mint any asset, and these assets are called synthetic assets. It does not represent anything, it just mimics the price movement of something in the real world. And the reason why you want to do something like this is first because it allows anybody from any country in the world to trade any assets without going through all these KYC restrictions or regulation barriers. And second is it solves these liquidity and slippage issues of DEX, which is good for traders. So DEX, the main problem is liquidity. So when there are big traders come in, there's a huge slippage usually when there's insufficient liquidity. But on Synthetix, if you trade, for example, SETH to SBTC, there's no counterparty for this liquidity. It's just debt conversion and the exchange of price oracle reference. So then the next question is, how are all these synthetic assets created? Is through collateralization. So every dollar of debt in circulation is collateralized. So if you stake SNX, you are actually providing collateral to mint all these synthetic assets. And if you want to withdraw your SNX, you have to burn these synthetic assets to withdraw out your SNX tokens. And all these synthetic assets that are floating around will be integrated by all these different applications in crypto. So for example, Quanta is a trading platform, Lyra is a options, 1 inch curve is a DEX. So they will allow you to trade all these synthetic assets on their platform. And there's also a trading fees when you do all these swaps of synthetic assets, mint, burn, and all these fees actually goes back to those who stake their SNX. And another source of revenue comes from SNX emissions. So this is based on target staking ratio, and also it will be escrow for 1 year. So if you stake SNX, your rewards will be distributed pro rata based on how much debt you actually have. And the second thing to take note is these rewards are actually based on which network you stake. And also you have to maintain your C ratio above 400% to claim the rewards. And this has to be done weekly. If not, then your rewards will be given out to others. And lastly, if your C ratio is below 150%, you have 12 hours to self-liquidate with a penalty of 20%, or you will auto-liquidate for 30%. So in summary, by staking your SNX, you are actually a put counterparty to all the dApps in the system. So later we'll go on to explain more about how this shared dApp system works. Is a bit unique. And second is trader losses will decrease the staker's dApp and traders profit will increase the staker's dApp. Again, we'll go through this later. So for taking on this risk, you are rewarded with 1 and 2, which is the trading fees and SNX emissions. So basically you just own a stake in a casino house and you earn trading fees, trader losses, interest fees, liquidation fees, and etc. So on point A and point B just now, here is an example of how it works. So let's say person A comes in, he put in a collateral of 200,000 and mint 50,000 of stable. So his collateral ratio will be just 400%, and this is how much he owes to the Synthetix protocol, which is 50,000. So if he wants to withdraw his SNX, he has to burn 50,000 of stables to get back his SNX token. And let's say person B comes in, he do the same thing, put 200,000 collateral and mint 50,000 of that, but the difference is he swaps his SUSD to SETH because he believes that ETH will go up to $2,000, and right now he also owes the system 50,000. So this is the interesting part. Let's say if ETH price actually pumps to $1,000, person B debt will double from 50,000 to 100,000, but person A debt will still remain the same because he's holding stables. But right now the global debt will be 150,000, and it is actually shared between everyone in the system. So what happens is actually after event 3 happens, A's new payable will be 75,000, it won't be 50,000, and B new payable will also be 75,000 because there are two parties in the system, and the global debt is 150,000. So let's say if I'm person B, I want to pay off my debt and withdraw out my SNX. I just have to sell 75 of my ETH at $1,000. I can pay back the system 75,000, and I can withdraw out all my SNX. But I still have 25 SETH left, and I still can cash out for 25,000 profit. But person B, if he wants to withdraw out his SNX tokens, he has to pay 75,000 from the initial 50,000. So he is actually at a loss, 25,000. So the lesson here is if you mint stables as USD, if other assets value go up, your debt actually increase. And if other synths value go down, your debt will decrease. So this is what I meant by traders' losses is equals to profits for stakers in the form of lower debts, and traders' profits is losses for stakers in the form of higher debt. So this is how you track the debt pool index. So if this goes up, then your debt actually increase. So this is not good for people who are staking. So that is what it means. Trader losses, staker debt reduce, and traders profit, stakers debt increase. And the risk is this protocol is extremely complex, and it requires the active management of rewards. So these rewards doesn't come automatically. You have to go and claim per week, and you have to maintain your C ratio above 400% to claim rewards. And also your rewards are distributed pro rata based on your active debt, so you also don't want this to be too high because then your rewards will be lower. So you have to maintain your debt ratio, and this changes based on a lot of variables such as SNX price, the traders profits or losses. But right now there's a solution. You can just hedge your debt by going to hedge or Taurus Finance, and Gelato you can auto claim your SNX rewards. You can read about it if you are interested. And B is you're betting against all these SNX traders. So they are a very complicated bunch of people. There are a lot of upbots, Oracle price front run, manipulation, and there are a lot of all these unknown loopholes that can happen that could destroy the whole system. And SNX stakers actually bear the cost of all these attack vectors. So example, if all these bots actually profit from loopholes, you are actually the one that is going to take the cost of it because now your debt is going to increase. And number 3 is scaling limitations. So since demand is limited by SNX price, this works the same way as how the relationship between MakerDAO and DAI. So even if there's a lot of demand for synthetic assets, you can't just mint any amount you want. You have to make sure that the SNX collateral is more than what you are actually minting, and it's very dependent on the whole crypto market on SNX price. And last is inflation. The emissions are quite high because they want to incentivize people to stake their SNX to grow their debt and to push volume. So this is a reflexive action that doesn't usually go well based on what we see in DeFi protocols. So that's a summary of how Synthetix protocol works. So now let's look at what happened recently. So to start off, actually people don't really want all this Synthetix asset because they prefer the native one. So Synthetix actually work with Curve Finance to pay out like ETH, SETH, SBTC. But then there's a problem, which is this Oracle latency, because the price of something and the price when you make the trade can be different based on the new price feed from the Oracle updates. So this create a lot of front running opportunities for the bots, and so they solve this by this fee reclamation method, which you have to wait for 6 minutes. So obviously people don't like this UX experience of waiting so long for a trade to be confirmed, and also for a synth to be minted, it actually requires equivalent Uni V3 token, and it requires SUSD to be at the source or destination of each trade. So because of all these reasons, integrators are not very keen. The whole process is quite clunky, and that's why their growth and traction is not really taking off. But right now, they actually released the atomic exchange function, and this allows synths to be priced directly by Chainlink and DEX Oracle. And also it removed restriction at the source destination to be SUSD. So there won't be any more waiting time, because now you can get the price directly without having to go through this checking back and forth process. So a lot of integrators got interested after they released this change. In particular, 1inch actually integrate these atomic swaps on Synthetix. And if you combine curve deep liquidity plus Synthetix zero slippage synths conversion, it creates a very powerful combo where you can swap asset A to asset D in this way. So A to SB, SB to SC, where S is Synthetix asset, and SC to D. So SB and A will be the same asset class, for example, as if, and SC and D will be the same asset class. So going through this route, traders are able to execute very large scale swaps with very minimal slippage because of Synthetix zero slippage sync conversion. And so you can see after 1inch integrates atomic swap, there's a sharp drive in volume, and they represent about 68-70% of Synthetix volume after this integration. And also March this year, Synthetix released their perps futures on L2 Optimism, Lyra and Quanta. So there's a lot of degen demand coming in, so this drive a lot of volume, and you can see that the unique traders and trade actually start rising since March. So all this also generate extra revenue for Synthetix protocol, which goes to the staker. And D is they also enable SUSD bridge between Optimism, Ethereum, so this will be more multi-chain. And E, they actually merge the debt pool together, so this allows Synthetix assets to be more fungible and they provide higher liquidity. And Jump Crypto is actually on board to support the liquidity of Synthetix. And G, the roadmap ahead is very interesting. So Synthetix is actually one of the most active DAO community. There's a lot of all these proposals. They actually work in this agile method where they keep trying, improving. So their proposal is really very active. And the most exciting one is curve integration, and also they are upgrading their perps futures. And more integrators will be coming in very soon. And lastly, right now, optimism narrative, perps narrative, real use narrative, decentralized stablecoin narrative is very strong. And this drives the whole Synthetix price up also. So how do you use this Synthetix asset, and how do you stake them? So first you have to decide whether you want to be on the Ethereum chain or do you want to be on the Optimism chain. Personally, I chose Optimism because if you look at their APY, they are actually generating 18.6% from SUSD trading. This is from Lyra and Quanta, and their inflation is 77%, and their staking APY is also much higher than Ethereum. You can see that Ethereum only 2.77% is actually the organic revenue, the rest is inflation. But with the curve integration and all this might change also in the future, so it really depends. So after you decide which chain you want to be on, just come over to staking, mint and burn, and just mint how much SUSD you want. So by minting, you actually have to first provide SNX as collateral, and by providing SNX as collateral, you are automatically staking already. So you can see I staked about 600 for a test for this video, and right now my C ratio is 389. So if I want to be eligible to claim, I have to burn some SUSD to be 400% so that I can claim. So if you go over to staking and debt, you can actually see how much debt you are issued and how much your active debt is. So you notice that my active debt and my issued debt is actually different. Right now my debt actually reduced. So this is likely because the debt pool, which you can see over here, as BTC and as ETH, which is some allocation over here, actually reduced recently based on the market dumping. So that's why my active debt is actually reduced slightly. So this is the global debt pool, and when you mint SUSD, your debt is actually inside here, part of here. And whenever this global debt value change, your active debt will change accordingly. So you have to maintain your debt properly. So I've come up with a simple way on what you should do after you stake your SNX and you mint SUSD. This is not the exhaustive list, but it's just some ideas that you can do. So one is you can just buy the debt mirror index to hedge your debt. So you can just do this in one click on their platform. And by doing this, you don't have to worry about your debt anymore. This is if you are neutral, but if you are bullish, then you can go for Lyra as EVOD or trade, buy something else, or do some LP on Velodrome. By doing this, you are actually betting that you can win against the global debt pool. So you are actually competing against SBTC as if in particular over here, since this is the larger allocation. And if you are bearish, you just want to stay in the stable farm, so you can put your SUSD at curve pool and auto compound at B Finance, or you can just put at Velodrome or Aave Lending. So your C ratio is below 400%, and this 400% will change based on governance, so by the time you watch this video, this might be different. And this usually happens when SNX price dumps or when traders are winning, or a combination of both. So you have to burn your SUSD to reduce the debt and bring back to 400% if you want to claim your rewards. Or either that, you just buy more SNX and stake to increase your collateral value. And if your C ratio is above 400%, then you don't have to worry so much. But if you want to maximize the rewards, because this is based on how much active debt you have, then you have to mint SUSD to increase this active debt. So that's an overview of how the Synthetix protocol works and how to stake them. If you want to understand more, just go over to their blog, and they have write a detailed blog post about all these staking things that you should take note of. So that's it for this video. I hope you find it useful, and if you want to see more of such content in the future, I've created this Notion page where I upload all my research and resources over here. So please subscribe, like, hit the thumbs up, and I'll see you in the next one. Bye.